Let's talk about the Instacart IPO, look at an article about what's been going on, and then some financials in this area. There's been quite a lot of fuss about the Instacart IPO due to the high volatility. So as you can see on screen right now, the ticker symbol CART here popped by 40% to open at $42 and then sold off throughout the day to close at $33. Alright, let's take a look at the stock price. We can see max data here going back to the 22nd of September. It's quite a new IPO. It has not been trading in the market so long, and in that time the company has fallen by 17%. Does that mean that all investors have lost money in this so far? No, not necessarily. If you bought in the IPO, depending on the IPO price, of course you will have lost as a retailer. If you're a larger institution, maybe you got a more beneficial deal, and if you were an early investor, well, it depends on at what seeding round you got in and at what valuation you got in. Right now the company is valued at 6.8 billion, so that's quite the large valuation, or is it? It's up to every investor to decide. But let's take a look at some of the things that's been going on. CNBC wrote about the 11% plunge that this company had on the second day of trading, and that wiped out almost all of its IPO gains. And as of making this video, all of the IPO gains are indeed wiped out. Let's just take a look at the key points here. Alright, so Instacart shares fell more than 5% in their second day of trading on the Wednesday, continuing to slide. That began immediately after the stock debuted on Tuesday. Instacart's falling share price suggests investors are still hesitant to back tech companies with challenged business model. We will comment on that later. Gene Munster, managing partner at Deepwater Asset Management, expressed some skepticism about Instacart in an interview with CNBC Closing Bell. Alright, promoting some other content from CNBC. And in the article, indeed, they go over this. They talk about some of the challenges here. For example, post-pandemic online grocery sales in the US, thinking that adoption is harder now that people are back out in society as normal as compared to during, for example, the lockdown area. But as a matter of fact, competition is quite steep in this area. We can see, for example, Uber having grocery delivery. We can see HelloFresh having Insta delivery. We can even see like local companies. For example, in Sweden, we have a local company that's been doing this for quite some time called Linas Matkasse. So there's quite a few companies doing what Instacart is doing in the market with its grocery delivery. Indeed, America, an extremely attractive market when it comes to doing business. There's potential to make a lot of profit being a market leader in America, but then you have to be a market leader as well, and you have to compete against all the other companies for a dominant position, and you have to drive this adoption that CNBC commented on was flattening from business in a post-pandemic era. So how do you drive this adoption? Well, it's going to be expensive. Instacart is going to need a lot of funding to do marketing and just push consumers into changing their habits from actually going to a grocery store and buying the groceries themselves to having delivery. They're going to have to add value add, maybe in the form of, having a recipe and meal planning for customers. But the problem in this business is the churn rate. So it's costly to acquire a new customer, and then they sign up for maybe a few months, a year, something like this, and then they churn after that. They don't continue to renew the subscription, and it's a lot cheaper from a business perspective to retain customers than it is to acquire new ones. So this is something that will affect profitability of this company. I haven't looked at the financials yet, so let's take a quick look at some of the numbers here. Alright, so we can see here for the latest quarter, revenue growth 15%, quite strong. and diluted earnings per share $1.15 per share. So indeed, this means that they have a price to earnings ratio, and the price to earnings ratio is priced for growth due to this increase, most likely. Let's take a look at some of the other quarters. They've had to file a lot of financial data before doing the IPO. This is not a SPAC, so we as investors have more information on this company. We can see earnings per share being negative for this quarter, and that was an increase from the previous quarter in the same the same quarter for last year on year. But a huge increase in revenue. Let's check. All right, 50% again. Interesting. And then a positive earnings per share. And then we'll see a positive earnings per share as well. What about profit margin? Is it staying consistent? 35% here for this quarter, 35 again, 16, 15. All right, so a drop off in the net profit margin. That's quite interesting. Must be related to operational expenses in some way. But revenue has a strong growth trend if we look at these previous quarters that they have filed. And then we see earnings per share being positive for all quarters except one. And as investors, this company has recently IPO'd. Of course, the management could have had a profitability focus, a growth focus, maybe done a lot of expensive investments prior to the IPO, and then planned, the last 4 quarters here, made sure that, all right, we don't do any super big investments right now, and we just, continue to coast on previous marketing, previous investments to show these great numbers ahead of the IPO. That could potentially be a case. That's something we need to be aware of. Or it's just, nice organic growth that's continuing to do fine. They're continuing to add more customers. That's also a possibility, and it's really hard to know. It's a new company. We don't have a lot of data, and we see profitability even in a very competitive market. So that's something that investors should be happy about. Yet stock price, as we saw, was sliding. So this company, Instacart, really high risk right now, given the low amounts of data we have, the recent IPO, the competitiveness of the market. And I'm sure one of these grocery delivery companies will continue to thrive and excel in the market and give investors huge profits. Will that be Instacart? Only time will tell. Alright, that's been it for this video, and as always, hope you guys make a ton of money, whatever investments you decide to make. Take care now. Bye bye.